Ever heard of a trader who turned a single day of market chaos into a fortune? Today, we're diving into the legendary story of Paul Tudor Jones and how he not only predicted the infamous 1987 Black Monday crash, but also made an estimated $100 million from it. How did he do it? It's a masterclass in market analysis, discipline, and nerve. Back in the mid-1980s, the stock market was on an absolute tear. Everyone felt like a genius, and the optimism was off the charts. But Paul Tudor Jones saw something different. He wasn't just riding the wave, he was studying the undercurrents. With his partner, Peter Borish, he started analyzing historical market patterns. They weren't just looking at charts from the last few years, they went way back. What they discovered was astonishing. They found a striking resemblance between the market action of the 1980s and the lead-up to the Great Crash of 1929. The price patterns, the investor sentiment, the speculative fever, it was like history was rhyming. Most people were ignoring these warning signs, caught up in the buying frenzy. But for Jones, this historical parallel was a giant red flag. He didn't just have a hunch, he had a data-driven thesis. Based on this analysis, Jones became convinced that a major correction was not just possible, but probable. He believed the market was a house of cards, ready to collapse. So, what did he do? He prepared to go short. In simple terms, he was betting that the market would go down. This was a hugely contrarian move. Imagine the conviction it took to bet against one of the biggest bull markets in history. He didn't just place one big bet and hope for the best. Jones was meticulous. He built his short positions gradually, managing his risk every step of the way. He used a variety of instruments, including stock index futures, to execute his strategy. He was preparing for a storm while everyone else was sunbathing. Then came October 19th, 1987, Black Monday. The Dow Jones Industrial Average plummeted by over 22% in a single day, the largest one-day percentage drop in its history. Panic swept through Wall Street. Fortunes were wiped out in hours. But while the world was in chaos, Paul Tudor Jones's thesis was playing out perfectly. His massive short positions turned into massive profits. It's estimated his fund, Tudor Investment Corporation, saw returns of around 200% in 1987, largely thanks to this one incredible trade. He didn't just save his clients' capital, he multiplied it during one of the worst market crashes ever seen. So, what's the key takeaway from this incredible story? First, it's the power of studying history. Markets have memory, and patterns often repeat. Second, it's about having the courage of your convictions, especially when your view goes against the crowd. And finally, it's about rigorous risk management. Jones didn't just guess. He calculated, planned, and executed with precision. The story of Paul Tudor Jones on Black Monday isn't just about making money. It's a timeless lesson in market psychology, analytical rigor, and the discipline it takes to be a truly great trader. It shows that sometimes the biggest opportunities are found when no one else is looking. Thanks for watching. If you found this story as fascinating as I do, make sure to hit that like button and subscribe for more deep dives into the world of finance. See you in the next video.